Now let's get the views of someone who sits on the UK's Shadow Monetary Policy Committee, the Institute for Economic Affairs. With me is Trevor Williams, Chief Economist at Lloyds TSB Corporate Markets. Trevor, thank you so much for coming in the studio. Right, I just wanted first of all to get your reaction to the breaking news we had over the last 15 minutes. Halifax prices for monthly house prices dropped the most since the index was started back in 1983. I mean, how concerned are you about this? Are we, is this the first sign of a double-dip recession?
No, I don't think it is. I think it's a sign that house prices, which have risen somewhat over the last 18 months, have now fallen back, frankly, because some of the increase was never justified. After all, you have a much more credit-constrained environment. Consumers and households in the UK are deleveraging, which is to say they're increasing their savings rates. And it therefore looks a bit odd that house prices started to pick up when they did. And the headwinds against it as well are pretty severe, which is slow growth in earnings, and of course the fact that the prospect of greater unemployment has risen with the likelihood of the fiscal tightening, which is talked about but yet to actually come.
Trevor, how concerned are you about this three-way split in the Bank of England? I mean, it does seem that it's always been difficult to navigate an economy, but it is just getting more and more difficult when you have to deal with other central banks doing something that actually you possibly don't want to do it yet.
Well, I think it's healthy, by the way, to have a split. I mean, it's a time of flux in the economy. There's a great deal of uncertainty. So I'd be frankly very worried if they're all absolutely sure about what to do next. So I think that it's healthy that there is a difference of opinion, because it's telling us that actually there are a number of options available. And the options are ones you've clearly pointed to. Leave rates on hold, increase them, or do some more quantitative easing.
But it's easier also to get it wrong if you have a three-way split, because actually, there are chances that everyone is a little bit right. What would you do?
Well, I think my vote is clear. The SMPC minutes show that I think that the economy has weakened a bit more over the last 3 months than I thought that it would. I don't think inflation is a serious issue because wage inflation is very low. Financial markets' expectations of inflation looking ahead is very low as well, so they don't think that inflation is going to become embedded in the system. There's a huge output gap in the UK as the economy is operating well below its long-run potential. So I think that there is scope to do more quantitative easing at a time when the financial squeeze is likely to take away some activity, but only on that basis. And that money should be forthcoming, not this month in my view, but maybe next month when you have a quarterly inflation reporting season.
Does the Bank of England need to do everything it can to make sure that the pound doesn't rise too much? I mean, we're talking about currency wars. What can the UK do to protect itself?
Well, I don't like this currency war phrase. I don't think there is any such thing. Currencies fluctuate. That's what happens when they're freely floating.